Hey there, YouTube. Welcome back to a market brief and the outlook. We'll look at CPI and PPI for the last week, and at the end, we'll talk about the bacon, egg, and cheese sandwich. And with that, let's jump in. All right, so last week we had PPI come in, actually lower than expectations. Consensus was zero point 0.3 for month over month, both on the headline and the core month over month. It came in at 0.3. And this was way lower than people were expecting. Here's what happened. You remember last month, we talked about these two numbers right here. Trade was 1.0 month over month. That was related to equipment and machinery, if you remember. That was the majority of the increase. This month, we had the same thing, but a decrease in equipment and machinery. So really, when you take a look at over here on the right, look at the change in final demand. You've got 2.4, 2.7, 2.4. 3.1 was the increase of machinery. When you took that little bit of a bubble out, you're now down to 2.6. So really, PPI didn't change if you take out that anomaly. Don't know what happened. I haven't spent a lot of time on machinery and equipment. And again, that's the trade margins, not tariffs and trade, that kind of trade, but it's the margins that they're measuring and the differences. We had a big bubble up, and then all of a sudden it popped and came right back down. So who knows what happened there with equipment, but that's what drove the significant decrease. So I'm still not seeing tariffs really come into the PPI. PPI is what producers receive. It does measure other things than CPI, such as insurance and things that aren't paid by the consumer. But still, I don't really see with these kind of numbers, I don't see tariffs having a big impact. Now, you do have a 2.8 year over year, and that's in the core. I don't think this is anything to be alarmed at. The core is just anything less than food and energy. All right, so I won't spend too much time there. And then that was on Tuesday, and then on Thursday, you had CPI, and it came in rather benign. You look, month over month, 0.3, forecast 0.3. Inflation rate year over year, 3.1, 3.1. Inflation rate month over month this is the headline, this is 0.4. This is a little bit high, and that's what I think people responded with a little bit initially, and then look at year over year, 2.9, 2.9. So this was rather benign. Interest rates did respond positively to this. I'll show you that here in a minute. I'm going to take a look at CPI. So month over month was 0.4. Let's go down and take a look at the all items. Here it is. All items is 2.9 year over year. These are the month over month, and this is year over year. And you can see some of the big ones. So there's food 3.2, energy looks like 0.2, and that's actually because some gas things have fallen there. And then you've got your core, which is all items less food and energy, 3.1, and 0.4. One of the biggest increases was shelter at 3.6 or 0.4 month over month. And let's jump into it a little bit more. Remember before I talked to you about the perception of what people think they can get for rent versus actual rent. So there's actual rent, it drops, but the surveys that they're filling out, it's still falling behind, and they're thinking year over year they can get 4% more year over year than they could, last year, but the actual rent is showing 3.5. That would probably be a little bit more in line with the Zillow numbers that we've looked at in the past. Remember, these are rolling 12 months, so they're 11 months behind. And this is also based on a survey. 35%, I think 27% of CPI is made up of a survey on what people think they can get for rent. Taking a look at inflation and CPI, or inflation and shelter together, there's CPI and there's shelter. So you can see there's my forecast that I had actually done probably a year or two ago of this green line where I thought the shelter component would be, because it does lag 18 to 24 months. And here we are, we're almost there. But while it said that was the biggest increase month over month and is the biggest contributor to CPI, once this gets down to here, you won't have shelter being a big component or big contributor. In fact, it still fell from what it was before, because the month before, I think it was like 4.1, and now we're at 3.6, so it's still falling. Take a look at this. Going back to food, there's shelter 0.4. Let's go look at food. Meats 5.6, 13.9% for beef. While this is only 40.47.5% waiting for CPI at 13.9, that's still going to have an effect. So wait till the Mexican maggot problem that they're having down there and the borders open up. You'll see this come down. So between this and shelter that we already know is coming down, we don't have an inflation problem. It shows at 2.9, but you remove 35% of it. Right here, 35% of this is 0.4, and that gets back down to normal here probably in about another, call it 4 to 6 months. You might be in deflation mode. So keep an eye on that. Look at this number here, initial jobless claims. This is a big number. This might have, between PPI and CPI, you might have saw interest rates retreat a little bit, meaning they would have went up. But because of this number here, this is 1 week. It is not a trend, but we'll see how this goes. It's been hovering around, I would say, between 220, 230. So last month was 236. They were expecting 235, but you had a 30,000 increase. Now, what I'm curious about is, does this have anything to do with the government layoffs that happened in January and February of this last year? I don't know yet. I think those actually start appearing on the books at the end of September, maybe a little bit early, to start reporting that. And if that's the case, then the number may be worse off. I just find it fascinating that you had a big jump in initial claims. This would be the people in line getting their initial unemployment. So that's a big number, and rates definitely responded because of that. And it's responded favorably across the curve. Then you had, on Friday, you had the Michigan consumer sentiment. That came in lower than people were forecasting. This is a survey. And let's take a look. Survey, consumers continue to expect higher unemployment and personal job loss. So look at the trend on that. We're at one of the highest we've been since 2009. So surveys are just that. They're surveys. I think there was 800 observations. So take it for what it's worth. But this could lead into a self-fulfilling prophecy. It is a little bit concerning that we're this high. All right, so how did rates respond? Let's take a look. So September 17th, this week, the Fed meets. There is a 100% chance of a rate cut. That's what the market has priced in. There is a 6% chance of a 50 basis point cut. Most likely it's going to be 25. Remember, this is just the front end of the curve. And then 3 cuts firmly priced in by the end of the year. I'm good with that. I think that makes sense. I think that's priced appropriately. So rates did respond very favorably because of the initial claims. And PPI and CPI were rather benign. Keep an eye on initial claims coming out again this Thursday. We shall see if that trend is developing. If that's the case, then that'll be favorable for rates. The other big event, which we'll get into in a minute, is the FOMC. That's all eyes on FOMC, and that's on Wednesday. Take a look. Tuesday, you have retail sales. This will tell us how people are spending, and building permits if you're into housing stocks, and then there's the interest rate decision, and then initial jobless claims. And then you got a couple of Fed speakers. No Fed speakers early this week because they are in the blackout period. They can't talk before 2 weeks prior to the Fed meetings on Wednesday. We get their interest rate. I expect a full rate cut, 25 basis points. But we also do get the September projections for what they think the next couple of years are going to be in terms of rates. So remember, 3 months ago, they said that interest rates were going to be around 3.9 by the end of the year. I would expect that to be a little bit lower on Wednesday, but we do get their forecast, and that's just it. It's a forecast. No, they don't abide by it. It's just they pencil in what they think rates are going to be at the end of the year, as well as at the end of next year and other economic activity. So keep an eye on Wednesday. That will be a make or break day, because what they say that day is what matters. The markets will move one way or the other. Interest rates are probably priced accordingly because I think they're already pricing in. It's the stock market that I think may have a wake-up call. We'll see. Speaking of the stock market, take a look at this. We've been talking about this seasonal downtrend. I still have that drawn out on the chart. This is seasonal. August, September, typically the worst months of the year. What seasonal trend? It didn't happen this year. That's going to set up for an interesting year end, depending on how unemployment shakes out. Each one of these shorts, I was short in the market. So each one of these, I took a little bit of profit, shorted again this week, and then that did not work out well because it just kept on going up. But I was somewhat hedged. It was a losing position. I did close that out. I may wait a couple of more days, and I don't know if I'm going to short right before the Fed meeting or wait till the news comes out and then short. But if I do that, I may miss the opportunity if there's a down day. If a down day happens, it'll be Wednesday, Thursday, and Friday. And then that would tee it up really nicely with this seasonal trend as well. You still have some negative divergences with RSI and MACD. You've got some bear signals from a technical perspective. And then also, fundamentally, look at the earnings. Earnings are 284.02 for all the shares in the S&P 500. That's great. That's good because all these earnings are rising. Look, 279, 281, 282, 282, 283, 284. So you have rising earnings. The market looks forward, but it really brought forward the price of those earnings at 23.18. That's very high. We've been in that 21, look, 22, 22, 22. Even in February when we hit all the highs before we went south on the tariffs, we were in the 22 range. So to be at 23, that's super high valuations, which is why I want to short the market because it shouldn't be this high. It's like the stock market is not aware of any of the bad news that's going on. Look at initial jobless claims. You look at rising unemployment. We've looked at the jobs report. Things don't look real healthy, but the stock market's just blowing it off and going, no big deal. How about tariffs? No big deal. And it just keeps on going up. It's like the buy the dip mentality is so firmly planted. Now, I do believe rates are good for the stock market when you have falling rates. That's definitely good. But there's still some noise that I think this is priced too high. I would like to see that probably closer to 21 or 22. But we'll see. We'll see what this week brings. And then if any kind of pullback that we get, if it's 2 or 3%, I'm going to be going long. I will be going long probably on small cap stocks because I think small cap stocks will favor very well with falling rates. I'm going to wait. I'm not buying here. Definitely not buying here. It's too expensive. And then I'll decide whether I'm going to short or not. So that's just a short-term thesis on the market. We'll probably have a pretty decent year-end rally. We're at 6,500, almost 6,600. Wouldn't surprise me that we see, I don't like making predictions, but maybe 6,800 by the year end. Hopefully we get a pullback. I'll go long, and then we'll ride that next wave up. All right, here's another thing about the PE ratio. So this PE right here is forward-looking. It's forward 4 quarters, so the next 4 quarters, looking at what the earnings are, and then the stock market is priced on forward earnings. This is rear earnings. The professional term is the trailing 12 months, not rear. Anyways, so 30.55, super high. You can see that we hit that mark in 2020, and that makes sense. But look, the last 3 or 4 years, it's just been climbing. And then even prior to the pandemic, you were in the 20 to 25 range. So 30 is very high. Whether you're looking in the past or whether you're looking at the future forward 4 quarters, doesn't matter. Either way, stock market is very frothy. Bond market's getting the news, but the stock market isn't. Speaking of bond market, look at the 10-year. One of the two is incorrect. Either the stock market has it incorrect or the bond market has it incorrect. They are conflicting signals right now. The bond market is starting to price in a recession. You can tell that based on the entire yield curve coming down pretty quickly. You were 4.3, not even a month ago, and now you're 4.06. So a quarter basis point drop on the long end. I was a little surprised to see that continue to come down, but that came down because of the initial claims and CPI and PPI coming in benign. That people thought that a lot of tariffs are going to be built in and the prices are going to be going through the roof. I said that wasn't going to happen. It's not happening. And now the market looks like a recession might be coming. And they're determining that based on unemployment because unemployment is definitely weakening. The Fed is data dependent, and so they are working on past data. So the Fed is a lagging indicator. They're now going to cut rates most likely this week. Almost 100% chance they'll cut rates, but it's almost going to be too late. There are long and variable lags in the market. It's going to take 12 to 18 months for that rate cut to even be felt in the economy. So it's going to be too late. They should have cut in July. I was for them cutting in July. They did not cut. Now 2 months later, they're going to cut. It's too late. And I think you're going to see a tipping point where you'll see the unemployment start rising faster. Hopefully I'm wrong, but that is my feeling. I think they've been too restricted for too long. Although, speaking of rates, this is the XHB Spider. It is all housing stocks that sit on the S&P 500. I don't know how many there are, but there are several housing stocks, anything from Home Depot to Lennar and Pulte and DHI and those guys. All those guys fit in here. There's some air conditioning companies in there. Anyhow, all of them together make up this spider called XHB. It's an ETF. And because rates are falling, XHB is having a heyday. $96 back in June, down up to $120. So over a 20% run. That's fantastic, and that's because rates are expected to fall. I would expect that XHB is probably a decent one to play. If I were going to do anything on this one, I don't know if I will. I would probably sell puts at around the 100 to 104, maybe, somewhere in this range. I would sell puts. That way I give myself some wiggle room, just collect some premium. I may do that, and because I do think housing stocks are going to do very well with falling rates, especially with all the pent-up demand. I can show you that on another day. And then almost to the last slide, this is what I'm going to do this week for put sales. There's a couple of companies reporting earnings. I have the wrong earnings dates. My apologies on that. They are reporting earnings not this week, but the following week. But these are the companies that I will be playing: Accenture, Micron, and Nike. I will be probably dropping my strike price. And why do I have my... Okay. I don't know why this strike price... This is wrong. My apologies. But we'll see if anyone watches this and catches that. Anyhow, the stock prices are right. The strike prices are wrong. I don't know why this has 160. That's messed up. But this 146 is, and this 225 is right. And I don't know what's up with Nike. Anywho, my apologies on that one. But these are the puts that I'm going to be doing. Again, I don't look at these strike prices. This is just a guide. What I do is I look at the implied volatility on Monday morning. I will make my decision based on implied volatility. I'll take the volatility, whatever expected move. Let's say it's expected to move $5. I'm going to put my strike at $7.50. I always go about 150% of whatever the expected move is, and that's where I sell my puts to give myself some wiggle room. Nike, I think, is probably a fair play. I do think they're going to be retreating a little bit, but they won't be reporting earnings until the following week, and for that reason, I will sell puts on this. Finally, my bacon, egg, and cheese sandwich index. You can go out to the Fred. This is St. Louis Fed, the Federal Reserve. They call it Fred. You can go out to the Fred database and you can go and pick about 1,500 different categories or prices on different commodities. There are thousands. I said 1,500 because that's just for the food side, but there is all kinds of prices out there. So I put together an index. I wish I could take credit for this. Bloomberg actually does this. They actually have a bacon, egg, and cheese sandwich with coffee index. Since I don't have a subscription to Bloomberg, I thought I'll just go create it myself. And so I went out and I went to the Fred database, grabbed the prices, and then I put together this index. And the reason I did that is because if you take a look at inflation, we're talking about inflation month over month. That's 0.3, 0.4. The problem is it is month over month or year over year. I wanted to show what does it look like all in. And take a look here from 2021. Your sandwich cost about $3.50. Today it's $5.50. That is a huge jump. What is that, 50, 60%? So a 50 to 60% jump in a breakfast item. That in 5 years, that's expensive. That's not like a 2 or 3% year over year. If you just make that cumulative, it's 50 to 60%. That's a huge number. And I think people are feeling that pinch. Every time we go to the store, take a look at steak. Take a look at beef. Beef, for example, is 20% year over year increase. And that's because of the commodity prices. The problem with that is Mexico and the tariffs with Brazil and this maggot that I talked about before. So those are some of the issues that we're seeing with beef. Long story short, bacon, egg, and cheese sandwich. I'll probably report on this every so often. And I thought it was just an interesting slide to show that things are getting expensive over the last 3 or 4 years. What you make today, you're thinking probably, man, if I made that one day, I'd be rich. And here you are your purchasing power parity has fallen a lot. And I don't think raises have kept up with it. So we're seeing this in delinquencies, and we're seeing this in a lot of different categories where people are starting to feel the pinch. That's why credit card debt's going up, and delinquencies on mortgages and auto loans are going up. I'll show that another day. So for now, that's it. Happy trading. Be careful this week. You have a big day on FOMC. That'll be the biggest day of the week and probably the day after. So keep an eye on those things, and happy trading. Good luck. See ya.